Hi, good day. We're here at the educational session on TIP TV. My name is Corvin Codirla, founding partner of CCFX, a systematic foreign exchange fund, now head of education at TIP TV, and also trading my own personal capital. The purpose of today's session is to look at money management. It's a topic that is quite popular with people. In particular, a lot of them focus on minimizing their risk. So if we go to the next slide. So what is money management? It comprises two things: reducing your risk, and at the same time also thinking about leverage. Now, reducing risk is system specific. A lot of people ask about where should I put my stops with regards to whatever system I trade or markets. That's a very difficult question to answer and specific to the system you apply. However, once you get the reduction in the downside of your P&L, you reduce your losses, it gives you the potential for massive upside via leverage. And the way to get the leverage is universal to most trading strategies, and this is what we will focus on today with some very surprising results. Next slide. So, there are two aspects to money management, as I said. The first one is always play defensive, covering your losses, and that's a quote taken directly from Paul Tudor Jones. Of course, legendary, used to score triple-digit returns back in the 80s, has several $1 billion under management in the BVIs. The second aspect is a famous quote by George Soros on the back of the pound exiting the ERM in 1992, where he said, "It takes courage to be a pig." And what he meant by that, when you know the markets are going in your favor, when you have identified an edge, that's the only way to make money, to leverage up. And it takes courage to do that because ultimately you won't know if you're right or not. So, before we get to finding the right leverage, you have to answer one important question, and that is, how much money are you willing to lose? When we were raising assets for my fund, that's the very first question I asked investors, and universally it turned out to be they don't want to lose more than 10%. So if you start out with $10,000, a lot of people are not willing to lose more than $1,000. Regardless thereof, the important point to bear in mind is that the amount you're willing to lose represents your actual capital. So forget about the fact that you're taking $10,000 and depositing it into your account. You only have £1,000 to play around with. But once you've actually found the amount of capital you're completely willing to risk, then comes the fun bit. And the fun bit really is Kelly betting. Now, people are familiar with Kelly betting from fixed odds betting, such as horses, blackjack, sports betting, etc. Now, there's a very big difference between fixed outcomes, where it's very binary, you either win or you lose, and outcomes where your distribution of P&L on each trade can be quite continuous rather than discrete. And by continuous, I mean if you look at a chart of returns, you'll find that any kind of P&L on trades can be achieved. It's not just win or lose. You can have returns from -2% right up to +2, similar to that. Now, the particular example I wanted to use today to exemplify Kelly betting is actually a very straightforward portfolio construction between equities and bonds. And the idea is that you can look at equity investing via indices such as the S&P as tracked by the ETF, the SPY, and bonds, well, how do you as a private investor participate in bonds? There are also ETF trackers such as the one with ticker AGG, which is the Barclays US Aggregate ETF, bond aggregate in the States, which in essence comprises fixed income instruments with maturities longer than a year, made up of both corporate, government, municipal, etc. Now, if you combine this in a particular way, you can get a P&L chart or a P&L distribution that ranges between -1.5, and you also had quite a high hitter month of almost 5%. But the point is, with this portfolio, you only rebalance once a month, and your average monthly return is of the order of 0.4%, with a fluctuation of 0.9 either side. So, how do we know how much to bet? Ultimately, that is the question we want to answer. And if you make 0.4% on average a month, that's per year something like 5.5%. That's not a lot to write home about. And the whole point is that as private traders, you're usually looking to get double digits, if you're lucky, triple digit returns. And that's where the leverage comes up. And that's why it's also important for me to stress that you need to have a bit of maths here in terms of looking at your trades and looking at the average and the standard deviation, that average swing around your average returns. Because once you have those two numbers, you can easily work out the Kelly ratio, which is nothing more than the average divided by the risk squared. So putting in the numbers we just had for that particular portfolio construction, it gives you 45 times leverage, which sounds quite a lot, and indeed it is, but what does it actually mean for the portfolio you've just constructed? It in essence means that the returns are absolutely astounding. So over the last 9 years, $1 invested would have led to $90,000, $100,000. And so that sounds preposterous, but it's based on some very fundamental principles which are at the moment exploited with much less leverage by very big hedge funds, such as Bridgewater, run by Ray Dalio in the States. He's got this all-weather fund, or AQR, run by Clifford Asness, who look at these kinds of portfolio constructions to create an appropriate profile of returns with regards to risk which are favorable, to then leverage them up. Obviously, they won't leverage full Kelly because full Kelly can take you on rough roller coaster rides. In this particular example, the maximum drawdown was 90%, so leveraging full Kelly is a scary ride. Not only that, should you leverage more than full Kelly, you more or less have a probability of 1 of going bankrupt. So what people therefore tend to do is to use only half the Kelly ratio. So in this particular example, you only leverage 20 times or even 10 times, which is sufficient, given that at the Kelly ratio, you're actually compounding 200% per year. So, in terms of how you can create these portfolios, how to trade FX as well under this kind of framework, sign up to my website. The whole purpose is to create a community of people who are equally passionate about the markets and understand that making money is not about finding the next holy grail, but about finding underlying principles which will pay you day in, month out. Thank you very much.